Hello, everyone. Welcome back to another edition of the Week in Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. Before we begin, if you're watching this on YouTube, hit that subscribe button for more content just like it, and go to creativeplanning.com/Charlie to schedule a call or a meeting with an advisor, and we're going to give you a free wealth path analysis, giving you a second look at your portfolio and financial plan, making sure you're on the right path to financial independence. At Creative Planning, we're located in all 50 states, so we likely have a location right near you. Over $325 billion in assets under management and advisement, and we're here to help. Go to creativeplanning.com/Charlie. What's on the docket today? A lot to talk about. We're going to discuss the jobs report, the Fed meeting again in 2 weeks, the most wonderful month of the year for the markets, Bitcoin passing 100,000, the Milei Miracle, and we'll end as we always do with something positive, and that would be more affordable rents in the U.S. Okay, let's dig in to the Goldilocks jobs report. Why am I calling Goldilocks? Well, not too hot, not too cold, kind of in a perfect position for the Fed to do one more rate cut. We'll talk about that in the second segment here. But let's start out with what the jobs report showed. It showed 227,000 jobs added for the month of November. That was above expectations, and the prior 2 months were also revised higher as well. So the fears about that low number that we got in October subsiding here, and we talked about that decline in jobless claims, which was really predicting that we would have a bounce back here in November. That's exactly what we've seen. And now we've had 47 consecutive months of positive jobs growth in the U.S. This is now the third longest streak that we've seen going back in history, and not that far from being the second longest. We only have to pass 48 months to get there. So just 2 more months of jobs growth, and it'll be the second longest streak in history. What happened with the unemployment rate? Well, it ticked up a little bit to 4.2%. So in terms of the overall report here, so we're showing better than expected jobs number, so beating expectation, but you have the unemployment rate going up. And of course, the Fed is looking at that unemployment rate number. So people are pointing to that as a reason why the Fed will ease again at their meeting in 2 weeks. And where were the jobs coming from? The top 3 categories will sound familiar. These have been the top 3 pretty much for most months over the past year. Number 1 being healthcare and social assistance, adding 72,000 jobs. Then you have leisure and hospitality, 53,000, and government, which has been a consistent at the top of this list here, 33,000 jobs added for the month of November. Now, in terms of the year-over-year gains, I never like to put too much into one jobs report. First of all, they're often revised in a big way, and just 1 month doesn't tell you the overall trend. The overall trend here is still slower jobs growth. So you still have this steady loosening of the labor market. So we had 1.4% increase in terms of the number of jobs over the last year. You can see that's the lowest that we've seen in terms of an increase over the past few years. You have to go back to 2021 to find a smaller percentage of increase. And if we look at hourly earnings here, this is the really interesting stat that we've seen this year, because most predicted that this would be lower at this point, and it simply hasn't happened. We're still seeing above average wage growth in the U.S. Of course, this is very good news for American workers. They're getting paid 4% more on average than they were a year ago. And as long as the inflation rate stays low, then you have a situation where workers are able to keep more money in their pockets. They're able to spend more on an inflation-adjusted basis. So certainly this has been helpful for the U.S. economy in 2024, and hopefully this continues into 2025. So let's talk about the Fed. One more cut before the pause. That seems to be the expectation. And it's a little bit surprising that the Fed would feel the need here to cut interest rates again, given this backdrop. So I laid it out here. You have stock prices hitting all-time highs. And we'll talk about that in a little bit, just how many we've hit so far this year. Home prices in the U.S. continue to hit new highs. Bitcoin, as we'll talk about, hitting all-time highs once again this week. And national debt, 36 trillion and rising. And then you have core inflation in the U.S., which excludes food and energy, but is smoother in terms of less volatility. It's been above 3% for 42 straight months, the longest run of high inflation we've seen in the US since the early 1990s. But then you have the Fed still saying they're going to likely ease when they meet in 2 weeks. And that's an unusual thing, I would say, to have this backdrop where financial conditions are so strong. You still have some signs of elevated inflation here, and yet the Fed is likely to continue to ease again. Look at the probability here. It's jumped up now to 89% probability that the Fed is going to cut 25 basis points down to 4.25 to 4.5% when it meets on December 18th. And as I've always said, the Fed pretty much does exactly what the market's expecting it to do. So if these numbers are anywhere close to this heading into that meeting, the Fed will indeed cut rates by another 25 basis points. But after that, I think it's going to get interesting. And if we look at the expectations for January, the market as of now is saying the Fed is going to hold at that point in time. And in 2025, in fact, the market's only saying the Fed is going to cut 2 times, 50 basis points. Now, of course, a ton is going to change in 2025. You could throw out all of these expectations, but I don't think that this idea that the Fed will start to be less aggressive in terms of cutting interest rates in 2025. I don't think that's a crazy idea just based on the data that we're seeing, and the trend in inflation seems to be moving upward here. And I think we're going to get an additional data point on that next week before the Fed meeting. And what we're likely to see is a CPI print that moves up to 2.7% for the month of November. And then later in the month of December, we're likely to see core PCE, which is the Fed's preferred measure of inflation, move up to 2.9%. And what the Cleveland Fed is projecting is that number is actually going to hit 3% for the month of December, and we're going to see CPI move up to 2.8%. So moving further away from the Fed's 2% target, and that's likely to drive the Fed to think about pausing for that January meeting, especially given all these other factors that we're talking about in terms of excessively easy financial conditions with credit spreads being extremely tight, and you have financial equity markets hitting record highs. And if we look at this real-time inflation gauge that Truflation puts out, I think this is another additional data point. I'm not sure that the Fed looks at this, that they probably should. This is nearing its highest level of the year at 2.8%. And again, if the Fed has a 2% target and we're moving further away from it, what would be the rush to continue cutting interest rates at this point, especially if we're going to risk seeing higher inflation because of these two factors here? Number one being the money supply is increasing again. So we talked about the Fed after 2020, 2021, where they had that record spike in the money supply. They pulled back, they actually contracted it a little bit, but now it seems like they're moving back in the other direction. We're seeing an increase in the money supply over the last year, and that's starting to accelerate a little bit over the past few months. So of course, that is a big driver of inflation, and if this continues to trend upward, well, that would change kind of the calculus in terms of what we should expect for inflation. And then, of course, number two, we have this issue of the national debt continuing to go up, which is, of course, inflationary because we're doing this massive deficit spending as well. So you have these two additional factors adding to the case that inflation is likely to stay higher for longer, and therefore the Fed is going to have to keep interest rates higher for longer as well. Okay, let's talk about the most wonderful month of the year. That would be December, and this is the probability of a positive return for the S&P 500 over the past almost 100 years or so here. And you can see December far and away has had the highest odds of a positive return. Almost 3 out of every 4 Decembers have been positive, so 74% of the time, higher than any other month. No other month is above 70%. And so far, it's been a good December. It's only been a few days, but we're seeing more all-time highs this week. 56 now for the S&P 500 on the year, and really that puts it in small company but good company with these other years here that have been among the strongest in market history. You have 1964, you got 1995, and then 2017 and 2021 more recently. So fifth place now all time in terms of the number of all-time highs. Just an incredibly strong year for the S&P 500. And I pulled this data point, interesting as well. We're up now over 29% on a total return basis for the S&P 500. And that would be back-to-back years. Let's say we end here above 25% for the S&P 500. That would be back-to-back years above that 25% mark. That's only happened a few other times. You got to look at 1935, 1936, so bouncing back after the Great Depression decline, 1954, 1955, and then you had during the 90s dot-com run up 1997 and 1998. If this holds, this would be only the fourth time in history where we have back-to-back returns above 25%. So very rare to see a 2-year period with stronger returns than what we've seen over the past 2 years. And what's going on here? Well, it's a combination of increasing earnings. So you definitely have an improvement in the fundamentals. Earnings are expected to increase 9.5% this year, or 3/4 of data we have already. So I'm using projections for the fourth quarter. But in addition to that, you have animal spirits going on here where investors are becoming much more exuberant about the stock market, and that's driving valuations up about 17% to S&P 500 P multiple of 26. So how does that compare with the historical average? Well, since 1989, historical average P ratio is a little bit under 20, around 19.7. So certainly above the average, a little bit over 30% above the average multiple. So we've seen now multiple expansion in 2023 and 2024. And this is not unusual for the S&P 500. The changes in investor sentiment is often much bigger than the actual changes in the underlying fundamentals. And you can see here, I'm illustrating the changes in the S&P 500's P ratio year to year. And you can see most of the time we're seeing double-digit swings. In fact, about 70% of years you see either a greater than 10% increase or 10% decrease in the PE ratio. So investors, their sentiment tends to be much more fickle than the actual underlying earnings data. In the last 2 years, we've seen just more exuberant sentiment, and a lot of that is really building upon the excitement around things like AI and the excitement that's going to lead to an increase in productivity, an increase in efficiency, and obviously higher earnings to come. And the big question for the future in 2025 is going to be, will we see that big jump up in earnings that investors are expecting? So we have to talk about Bitcoin hitting 100,000 this week for the first time. A lot of this is on optimism that we're going to see a more friendly environment for crypto. Now, this is interesting because Bitcoin had done extremely well over the past 4 years, but the expectation, I guess, is that it's going to do just as well or maybe better because of these changes that the new administration is going to make. So Trump nominated Paul Atkins as the SEC chair, and this week he also nominated David Sachs, saying he will be the AI and crypto czar. We don't really have any details yet on what the specific policy changes will be, but the perception is it's going to be more crypto friendly, and Bitcoin trades more than anything else on the narrative, and the narrative, of course, is that this will be in some way positive. So people have been buying into it, and I'm highlighting here the road to 100,000, and in blue here is what's happened, what's transpired in Bitcoin since the election. And you can see here, hit 74,000, and then this week we're above 100,000 for the first time. And really remarkable because 11 years ago, we were just at 1,000 in terms of Bitcoin. So 100x increase for Bitcoin in the last 11 years. And if we look at the year-to-date gains now, 144% on top of the 156% in 2023, you could see extremely volatile asset class is Bitcoin. The gains have been enormous, but the downside in down years has been enormous as well. So still a lot of volatility in this asset class, despite the fact that more and more people seem to be participating. Now, this is an interesting question that I dug up. Was there any stock in the stock market over the last decade that has actually outperformed Bitcoin? And I looked through the Russell 3000, and there was only one name. You could probably guess it, and I'm showing it here. NVIDIA, only name in the Russell 3000 index that outperformed Bitcoin in the last decade with a 28,620% return versus 26,180% for Bitcoin. Now, since the election, the big winner continues to be so far crypto. And again, we've talked about the narrative behind that is just you're going to see a more friendly regulatory environment towards Bitcoin and crypto in general. You can see Dogecoin still the leader here. MicroStrategy, kind of the levered Bitcoin play, up 78%. Bitcoin, 46%. Tesla, of course, still doing well. And then you have small caps outperforming, international stocks starting to creep back. The dollar is coming down a little bit. Bond market is back in positive territory. So some of these moves are starting to reverse here. International stocks getting closer to back to even since the election. But the thing, I guess, that has persisted and even accelerated a little bit has been the moves in crypto, and then volatility on the other end just absolutely crushed. The VIX was over 20 heading into the election, and now it's at its lowest levels in months. And this was just a crazy stat on Dogecoin that I pulled up here. Oldest bank in the U.S. is the Bank of New York, founded in 1784 by Alexander Hamilton. Now it's known as BNY Mellon. And Dogecoin's market cap this week actually hit 69 billion, which was $10 billion higher than what BNY Mellon is valued at. Now, BNY Mellon has $18 billion in revenue, 53,000 employees. So just kind of unbelievable that this meme coin known as Dogecoin is actually has a higher value today than a company like the Bank of New York Mellon. Just an unbelievable, stunning stat that kind of shows you where sentiment is right now for crypto in general and speculative crypto meme coins like Dogecoin in particular. Okay, let's move on to number 5 here. The Milei Miracle. Javier Milei elected president of Argentina last December. Things were not good when he took office. You had the monthly inflation rate 25.5% back then. And you can see what's transpired since that point in time, a steady decrease. Now we're down to 2.7%. Kind of unbelievable. How did we get there? Just a monumental feat in terms of cutting spending. I don't think anyone thought, even though he had suggested he would try to do these things, I don't think anyone thought that he would actually be able to do it. Slashing federal spending by 32%. He's cut the number of government ministries from 18 to 8. He's reducing subsidies, freezing public work projects, and he's actually generated Argentina's first government surplus since 2008. So all of these things combined are bringing down the inflation rate. It's expected to continue to go down in the coming months. And the Argentina, if you look at their equity markets here, I'm showing global equity ETFs here, number one equity market so far in 2024 with a 64% return. You could see the worst performer here, Brazil, right next to Argentina, actually down 23.5%. Very different policies in Brazil with deficits very high. So taking obviously a much different approach to Argentina. And the big question for the U.S. will be what happens here in terms of Doge, not Dogecoin, but the Department of Government Efficiency. Will they try to enact some of the things that Javier Milei is suggesting? Well, in order to do that, they're going to have to get that passed through Congress and the Senate. So I have no doubt that they're going to find waste and fraud. They've been outlining it week after week here, giving examples, and they seem to have some bipartisan support, which is a good sign, but we'll see what actually transpires in terms of what they're actually able to do in terms of cutting spending. And of course, this is the reason why we need to cut spending, because we have a deficit of $2 trillion. So we're going to continue to add to that national debt. It's going to become harder and harder to pay that debt back with interest rates being where they are. So this is definitely an important issue. We'll see if they can tackle it. We don't have any of the data or information yet to suggest how much they're actually going to be able to cut, but the expectations seem to be very high. So hopefully they'll be able to do something, because this is not something we want to pass on to our kids and grandkids. We don't want to let this turn into a crisis that we can't move back from. And I don't think it's too late in terms of cutting this and getting back to a balanced budget. If we did that and we let the economy grow, I think we could grow our way out of the problem. The idea of actually reducing that national debt, much more challenging thing, but to actually bring the deficit down to zero, to bring the budget down to zero, and then let the economy grow into that. I think that's definitely possible. You just need to have the political will to do it. Okay, let's end with something positive, as we always do, and that would be looking at rents. This is the number one category in CPI, so very important. People spend more money on housing and shelter than anything else, and I've been highlighting this every single month because it's moving in the right direction. And we're seeing yet another year-over-year decline in terms of asking rents. This is data out of Apartment List showing a 0.6% decline in the past year. And you can see here the steady year-over-year declines. What that basically means is the asking rent. So if you're looking at landlord and they have an apartment for rent, they're asking less on average than the year before. And you can see here the the average price of rent here has actually not hit a new high over the past few years. It peaked in the summer of 2022, and it's actually lower today than it was back then. That's great news, but what's even better than that is people's wages have been going up over this period of time. You can see this is average hourly earnings, as we talked about earlier, actually up 4% in the past year. So what I do is I adjust this chart for that increase in wages, and this is what it looks like after you do so. It's showing you rents adjusted for wage growth, and you can see here we're now at the lowest levels since early 2021. So very good news, but much better position if you're a renter today than a few years ago, because your wages have gone up and rents are either down or flat over that period of time. So that makes that monthly rent much more affordable. So good news. Hopefully this continues, and it seems likely that it will, because we're seeing supply in the rental market continue to be high, and that's the best indicator in terms of future rents. You have a lot of vacancies, so there's less ability for landlords to raise their prices. So this should keep a cap on rents for at least a few more months, should continue to get more affordable. Good news for sure. Okay, we'll end it right there. Have a great weekend, everyone. Thanks for watching the Week in Charts. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Week in Charts.